$60,000 was supposed to be the floor. The line traders had been defending for months. This week, Bitcoin fell straight through it. And the reason wasn't really a headline out of Washington. It was crypto eating its own winners. Here's where things stand. Bitcoin dropped below $60,000 on Thursday, its weakest level since October 2024, before clawing back above it as the week closed out. On the week, it's down around 16%. Ethereum took it worse, off close to 20%. And the broader tape was ugly across the board. Dogecoin and Shiba Inu down roughly 9%, XRP sliding to multi-month lows near $1.10. Yes, there was a macro trigger. A hot U.S. jobs report revived fears the Fed could hike instead of cut, and risk assets sold off. But that's the spark, not the story. The story is what was already on fire. Look at what fell hardest, and a pattern jumps out. The biggest losers this week weren't random. They were the exact trades that led the rally. Hyperliquid, down around 15%. Near, down nearly 20%. Venice token, about the same. These were the hot hands of the last run, and they gave it all back in days. Even Arthur Hayes, who rode some of these, said he dumped his entire Hyperliquid and near positions, calling a market top. When the leaders lead the drop, that's a positioning unwind, not a fundamental story. Over 4 days, more than $4 billion in leveraged bets got liquidated, and roughly 93% of them were longs. And then there was Zcash, the single strangest story of the week. Zcash had been one of the privacy coin darlings of this cycle. Then Shielded Labs disclosed a vulnerability in its Orchard shielded pool, a flaw that had been sitting in the code, undetected, for 4 years. What surfaced it? An AI model. Zcash cratered, down around 40% at its worst, before settling. Arthur Hayes dumped that too, and bearish bets hit a record high. Here's the part that should make every holder sit up. Researchers are warning that if an AI can find a 4-year-old bug in a major privacy chain, similar flaws may be hiding across crypto, and across traditional finance too. The same tool draining money out of crypto and into AI stocks just doubled as the thing that cracked one of crypto's own. Now, if you only watched prices, you'd think the whole industry was in retreat. It wasn't. While tokens bled, the plumbing kept getting built. Securitize, the BlackRock-backed tokenization firm, cleared its last big hurdle to list on the New York Stock Exchange. JP Morgan, Bank of America, and Citi confirmed a shared tokenized network to defend their deposits against stablecoins. And in a quiet first, a Michigan couple closed a Fannie Mae-backed mortgage using Bitcoin as collateral. Price down, infrastructure up. Both can be true at once. So back to that $60,000 floor. It broke, and then it bounced. But one green afternoon heading into a weekend is a relief, not an all clear. If this was the rally's froth burning off, the crowded trades, the leveraged longs, a privacy coin with a 4-year-old crack in it, then the floor breaking is healthy. If it wasn't, 60,000 stops being a floor and starts being a ceiling. We'll know which by how this weekend's bounce holds. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.